Hey, good morning, options traders. I hope everybody had a great weekend. And I wanted to answer a very common and important question that I get asked a lot by traders. Is a naked call riskier than a naked put? Now, on the surface, you're probably thinking, well, of course it is, but you might be surprised. Let's go take a look and find out why. Before we do, as always, please be sure to click like and subscribe. Very much appreciated and helps so much to promote the channel. So for those who think that a naked call is riskier than a naked put, this is usually the argument that they suggest. They'll say, well, the risk graph for a naked call has unlimited upside. And because there's no limit on how high a stock's price can rise, it has theoretically unlimited risk. A naked put, on the other hand, goes in the opposite direction. And so a stock's price can only fall to zero. And so they say, all right, well, obviously there's less risk for the naked put, because you do have this lower bound on a stock's price. Well, that's definitely true, but that doesn't necessarily mean the risk is less for a naked put. First of all, ask yourself, how often does a stock price fall to zero, especially over a relatively short time? Not often. And so the thing that you have to understand is that, yes, maybe in an absolute sense, in the extremes, a naked call is theoretically riskier, but also remember that markets can melt down. Markets can have panic attacks with significant drops in a single day. Anybody who's even been trading as little as the last couple of years has certainly witnessed those, especially through COVID. And the reason for this, the potential for massive drops in a single day, is called risk aversion. People just hate to lose money. And so as soon as they see markets starting to fall, everybody thinks the same thing at the same time. Everybody sells, it triggers stop orders, and it just becomes this domino effect. Just for a couple of quick examples, everybody knows about October 19th, 1987, where the Dow dropped about 23% in a single day. Now, the largest up day the Dow has had was March 15th of 1933, where it jumped 15%. So again, yes, markets can have big jumps up, but they're rarely as big or as frequent as they are to the way down. So remember that markets rarely melt up. However, the bigger risk is implied volatility risk. This is the one that traders overlook. Implied volatility presents a bigger risk to the downside. So the bigger risk is that the implied volatility can spike up when markets fall. And so if you're short puts, the added implied volatility only adds to the losses. But implied volatility never spikes up when markets rise. In fact, it usually falls. And that would be an added benefit to short puts, and even to short calls for that matter. Now, yes, the short calls might be gaining intrinsic value, but you're still getting a benefit from the drop in the implied volatility. Now, I've talked about this next risk before, but this is also a good video to revisit it because it's a very relevant risk, and that is normalized vega. So normalized vega means we're going to take the vega of that option and divide it by the option's price. And when you do that, it shows the percentage change in an option's price for a one-tick move in volatility. So what's a one-tick move? Well, it just means that we're adding or subtracting 1 from the current volatility. So in other words, if volatility rises from 20% to 21%, that's a one-tick increase. Or if it falls from 20% to 19%. And what normalized vega shows is how much is your options price going to change in terms of percentages. So for example, let's say we have a $100 call that a pricing model says is worth $232 and it's priced at 20%. We look on our broker's platform and it says this has a vega of 0.11. So if volatility rises from 20 to 21%, that call should pick up 11 cents. It's going to rise from about 232 to 243. Now notice our normalized vega is the 11 cents divided by the 232 call price, which is 4.7%. And notice that the $2.43 new options price divided by the old 232 price is exactly increased by a factor of 1.047 or 4.7%. So that's exactly what normalized vega shows us. So why is this important to look at normalized vega? Traders normally look at vega and just say, oh, it increases or decreases by 11 cents. And they'll say, oh, well, 11 cents isn't that big. Well, possibly. But what if it's a big percent of the option's price. That's really the bigger risk. So this becomes a particular risk for out-of-the-money option sellers. So yes, at-the-money options have the largest vegas in terms of the absolute raw number, but out-of-the-money options have the largest normalized vega, and this is the part that's a little bit of a hidden trap. And so therefore they cause the largest percentage changes. And again, if you think about it, the percentage changes are a bigger risk. So from a pricing model standpoint, if you double volatility, an at-the-money options price doubles. However, out-of-the-money options go up multiple times more. Again, this is the big kicker. And as volatility rises, traders are tempted to sell further out-of-the-money options, which really only makes the trade riskier. And they keep wanting to sell these very far out-of-the-money options for pennies, and then usually have to sell far more contracts to make it worth their while, not realizing they're stepping into a very big potential trap. So for example, if we go to a pricing model, and I'm going to use a $200 stock price just so we can really move away from the strike and exaggerate the example. Notice that I have volatility set at 20%, and our call and put prices are about $4.57. However, notice if we double volatility to 40%, the call and put prices double. But watch how different this is for the out-of-the-money options. So let's keep the stock at 200. We'll make the strike 185. So 15 points out of the money. And now it's saying, yeah, these puts are only worth 44 cents. And this is where traders will say, oh, well, let me sell it 10 or 20 times or 50 times because it's got a low probability of going in the money, and therefore I can get kind of some free money here. That's the way that they look at it. And they'll say, oh, look at the vega. It's fairly small. It's only about 9 cents. Well, that's true in an absolute sense, but normalizing it, if we look at 0.0873 divided by the put price, it's 20% of the put's price. So watch what happens now if we double volatility to 40%. Now that put goes up 638%. Big difference from doubling. Now let's also assume that the stock price falls a little bit. Maybe this put doesn't even go in the money, but it falls from 200 to 190, just a 5% drop. In fact, this drop in the stock's price is probably what's pumping up the volatility. So these two usually go hand in hand. Now look what happens. Now that puts trading for over 631. That's an increase of over 1,330%. So the thing to realize is that it is the bigger risk for these naked puts. And again, traders may sell more of these out-of-the-money contracts to receive the same dollar value. And that means their risk rises exponentially. So take a look at some of these other strikes. So with the stock at 200, if we had the 200 strike, the price of the put would be 678, the vega would be about 23, and the normalized vega is quite small, 0.03. If you sell the 195 put, the price drops, but look at the vega dropping as well, but the normalized vega is increasing. See, if you start wanting to sell further out of the money puts, you might drop down to this 185 strike for $1.61 and say that the vega is 14, but look at the normalized vega, almost 9%. But look what happens if we come way out here to maybe the 160s. See, now they're selling for only 2 cents, and traders say, sell a ton of them. It's like free money. But look at the normalized vega, over 31% of the put's price. Yes, it has a small vega, but relative to the price you're receiving, it's massive. And that's the point that most traders miss. So just remember, for anybody who might be selling naked options, first of all, understand that is a much bigger risk than you need to take, no matter how small it might look. There are much better ways to hedge the positions to get reasonably close to the returns that you're looking for without all of that risk. However, for those who still insist on selling naked options, just understand that selling naked puts is probably the far bigger risk than selling naked calls, even though in an absolute sense, you could certainly make the argument that selling naked calls is riskier. But from a practical standpoint, be very careful of selling naked puts, and mostly because of normalized vega. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.